In this video, I'll mention a rarely talked about alternative for a savings or a money market account, and we're starting right now. Hey guys, welcome to the Keystone Financial Academy. My name is Elliot, and in this video I want to discuss where you can put your money in this ultra low interest rate environment. Let's get into it, and as always, if you enjoyed this video and find it useful, please don't forget to subscribe to the channel and smash that like button. So as I'm sure you've noticed, if you try to open a savings account at your local bank in recent months, the average interest that they pay nationwide is about 0.06%. You can then of course go to a high-yield savings account, which is also known as a money market account, but they only pay on a nationwide average 0.5 or 0.6% interest. It's certainly a lot better than a regular savings account, but still pretty bad. I mean, the rate doesn't even cover inflation, so you're technically losing money by keeping it in any of these accounts. So what do you do now? Well, the standard advice is to say that the savings accounts are really just for emergency or short-term temporary use, and you really should be investing. This is a very true statement, but investing is a whole different game. And what if you just wanted to save your money and not necessarily invest it? Is there some way you can combine savings and investing and have your money earn a higher return while still being about as safe as you can get? Well, if you don't mind sacrificing just a little bit of safety and want to earn a much higher return, here is a suggestion that's quite unconventional. Now, you probably heard of dividend investing, and maybe you have a few dividend paying stocks in your online brokerage account. They're basically stocks that pay you to own them, and if you need a review on this topic or maybe a full introduction, there's a link in the description below to a video I did on that very topic. So what if you build up a dividend portfolio and use that as a long-term, high-paying savings account? In other words, you'll be essentially diverting all the cash you were planning to put into a bank savings account or a money market account and instead purchase certain types of dividend-paying stocks. Now, I know this sounds crazy when you first hear it. After all, both savings and money market accounts are protected by the FDIC against loss, and investing is known as being risky, where you might lose your principal. Those are all true statements, but we are so conditioned to hearing that investment is risky that we don't stop to consider that the risk varies tremendously depending on what it is you're investing in. And that in turn has to be balanced against the reward. So as an example, on the one extreme, you can drop a bunch of cash into a regular bank savings account and it will sit there completely risk-free, protected by the FDIC, but it will earn you next to nothing and will in fact lose money for you. That does not sound like a good risk versus reward ratio. On the other hand, you can invest your cash in something like penny stocks or crypto or other very risky assets with the potential to earn some massive returns, but along with that comes virtually unlimited risk that you can lose all the money you initially invested. So the trick here is to find a happy medium where your money is safe enough to be considered almost but not completely risk-free while still earning a decent return. Given the choice, people will accept a higher measure of risk to earn more, because to accept 100% safety will mean that you earn next to nothing. Okay, so if you're on board with me so far and agree that some risk is okay, then let's discuss how dividend investing can be a great alternative to a savings or money market account. The key is what I said earlier. In order to build a savings account out of dividend stocks, you need to invest in very specific ones. These are stocks from unglamorous, well-managed, rock-solid corporations that deal mostly with consumer staples. What this means is that they sell products and services that we all need and buy, regardless of whether the economy is going up or down. That makes these companies very stable, and if you look at their long-term stock price, it varies very little and generally goes up gradually or on occasion even significantly. You don't get a huge run-up in price like you would with a hot tech, biotech, or energy stock, but you don't really get much of a decline or a sharp drop-off either. And that right there is why these companies are great to put money into for a steady return. They are about as safe as stock investing can get. Now, are they completely risk-free? No, of course not, and the stocks do occasionally decline because there's just no such thing as a risk-free equity investment. But these companies make a profit in all types of economic environments, and while their stock price has dipped a little bit here and there, it recovered quickly and continued on its steady and occasionally sharp rise. Okay, so as far as safety, consumer staple stocks are about as safe as stock investing can get. But what about returns? After all, what you're trying to do here is get significantly more for your money than a savings or money market account. Well, here is where there's some good news too. All of these top quality stocks from the consumer staples companies pay between 2 and 3% or somewhere in that neighborhood. That's 5 or 6 times more than the best money market account you can find right now, and something like 40 to 50 times more than the typical savings account. You can also adjust your risk factor if you feel comfortable and invest in a few companies that pay as high as 4 or even 5% dividend returns. But my recommendation would be to stick with the best of the best, which typically pay out in a 2.5 to 3% range. So finally, what are some examples of such safe dividend-paying companies? In no particular order, here are my top 10 suggestions that you would take a look at and research further on your own. The first is Procter & Gamble. This reliable stock has been on the rise pretty much since the beginning and currently pays out a 2.47% dividend. The second is Johnson & Johnson. This stock also has been on a steady rise since the beginning and currently pays out a 2.46% dividend. The third is Colgate-Palmolive, another consumer staples company. Its stock has pretty much only risen and currently pays out a 2.14% dividend. The fourth is a store that everybody knows, Walmart. Their stock has been on a fantastic rise in the last 5 to 6 years, and they pay out a 1.54% dividend. The fifth is 3M. This is a company that manufactures thousands of products for consumer use, and after a brief downturn in its stock, it's on a sharp rise again. 3M pays out a 2.97% dividend. Stock number 6 to look at is Coca-Cola. One of the most recognized brands in the world, this stock slumped a bit in the late 90s and early 2000s, but has risen steadily since then and currently pays out a 2.93 dividend. Coming in at number 7 is Kimberly-Clark, another consumer staples company, and hopefully you're seeing a pattern here. Their stock has seen nothing but an upside over the long term and currently pays out a very healthy 3.35% dividend. And number 8 is everyone's favorite golden arches, McDonald's. Now, fast food is officially part of the consumer discretionary sector, but if you pay attention to how America mostly eats, then it's clear that Mickey D's is really a consumer staple. Its stock has rocketed up in the last 20 years and currently pays out a 2.09% dividend. Number 9 is PepsiCo, because as goes Coke, so does Pepsi. Its stock has seen nothing but an upside since the beginning and currently pays out a 2.72% dividend. Finally, at number 10 is Hormel Foods. This multinational food manufacturer operates dozens of familiar brands, and except for a brief dip in 2016 and 2017, its stock has been on a constant rise since the beginning, and it currently pays out a 2.05% dividend. So these are just some of the quality stocks that are out there that are not volatile, nearly always rising, and about as safe as stocks can get. Many of these are also dividend aristocrats and raise their dividends for many, many years, sometimes decades. While these dividends are not sky high, remember what we're talking about in this video. You want to use these dividends as a substitute for a savings account. Therefore, preserving the principal is of utmost importance. But having said that, these stocks also do appreciate and pay out a pretty decent dividend between 2 and 3% on average, which, as I mentioned earlier, is a lot higher than a bank savings account or a money market account. So altogether, you get an income from the dividends and capital appreciation, a rise in the stock price, all with a significant measure of safety, which taken together is something no savings or money market account can match. So is there a downside to using dividend stocks as a form of a savings account? Well, the most obvious downside, and one everyone will think of first, is the possibility of a decline or fall in the stock's price, which does happen occasionally on a short time scale. The solution here is to use dividend stocks as a savings account only for long-term savings. savings, more than, say, a few months. That way you can ride out any temporary dips in the market, but as you saw from the charts, these companies make a profit in virtually any environment, whether it's a booming economy or a recession. And the stock price has never permanently fallen in the history of any of the organizations that I mentioned. Another downside is that you'll have to pay capital gains both on the appreciation of the stock if you decide to sell it and on the dividends that the stock pays. However, qualified dividends and capital gains are taxed at a lower rate than your typical person's salaried income. And in the end, you're still going to walk away with a much better return for your money than you would get by keeping it in the savings or money market account. So, should you try this approach? Well, it's certainly an unconventional way of thinking about a savings account and saving money. Truthfully, you are investing here, not really just saving money. But if you really think about it, it's quite a bit of a gray area anyway. A bank uses the money you put into your savings account or money market account to invest itself and pays you interest for the opportunity to use your money. So in the end, you are investing anyway, just not directly. So the bottom line is all interest earning financial activities are investing in one form or another. So in the end, you can call it whatever you want. Saving, investing, it doesn't matter as long as your money is not sitting idle but earning some form of interest for you. Alright, so if you've enjoyed this video and found it useful, please consider subscribing to this channel and turning on notifications so you don't miss any future videos just like this one. Thanks for watching and I'll see you all soon.